Hello everyone and welcome back to Explain the Charts. Today, July 23rd, 2025, we're putting the spotlight on the US dollar to Canadian dollar currency pair, which has seen some dramatic price action recently. First, let's look at the current events and news driving this pair. Recent headlines indicate that the US dollar to Canadian dollar is approaching multi-week lows, currently trading around 1.36076. This weakness in the US dollar is primarily attributed to growing trade uncertainty and speculation around the Federal Reserve chair. The DXY index, a measure of the dollar's strength, has consistently dropped below 98 points, reinforcing this bearish sentiment for the greenback. Simultaneously, the Canadian dollar has gained significant strength over the past two trading sessions, contributing to USD/CAD's decline below 1.37000. A major upcoming event is the interest rate decisions from both the Federal Reserve and the Bank of Canada, scheduled for July 30th. Both central banks are widely expected to maintain their current rates, the BC at 2.75% and the Fed with a high 95.3% probability of holding at 4.5%. However, the inflation data tells a different story. U.S. inflation is at 2.7%, while Canada's is lower at 1.9%, already below the 2% target. This gives the Bank of Canada more flexibility for a dovish policy, while the Fed might be forced to keep rates higher for longer, implying a more hawkish stance. Such a rate divergence could potentially renew demand for the US dollar in the long term, suggesting that the recent CAD strength might be temporary and a sustained bullish phase for US dollar to Canadian dollar could resume in the future. Now, let's turn our attention to the charts to see how these fundamentals are playing out, starting with the daily time frame. Looking at the broader view, we can observe significant volatility in US dollar to Canadian dollar throughout 2024 and early 2025. You'll notice several extreme, sharp single-day drops, such as those in late October and November 2024. These massive percentage declines, sometimes over 5% or even 10% in a single day, are highly unusual for a major currency pair like US dollar to Canadian dollar and are likely data anomalies. Our analysis will focus on the more consistent, underlying price action, ignoring these outlier spikes for a clearer picture. Excluding these anomalies, the pair exhibited a general upward trend for much of 2024, reaching highs around 1.44 to 1.45 in late 2024 and early 2025. However, since early 2025, particularly from May onwards, US dollar to Canadian dollar has shown a clear reversal, entering a distinct bearish phase. The price has been consistently making lower highs and lower lows, breaking through what were once significant support levels. The latest daily candle from July 22, 2025, closed at 1.36044, confirming the strong bearish momentum and placing the pair firmly at multi-week lows, aligning perfectly with our news reports. The news mentioned 1.3670 as a multi-week low that has now been breached, with prices pushing even lower. Previous supports at 1.3700 and 1.3650 have now effectively turned into resistance zones. Let's zoom in on the 1-hour chart to examine the recent price action more closely. Here, we can see the short-term bearish trend that has driven the price down. Notice the steady decline and consolidation around the new lower levels, particularly evident in the first week of July. The current price is hovering just above the recent June 2025 low of 1.35726. This hourly chart clearly illustrates the persistent selling pressure on the pair. Moving to the 15-minute chart, we gain an even more granular view of the immediate price movements. This time frame highlights the intraday fluctuations and confirms the strong bearish bias we've been discussing. You can see how selling pressure has dominated, with brief periods of consolidation before further declines. The current levels around 1.3600 are testing critical immediate support. This short-term weakness is directly influenced by the current US dollar sentiment, impacted by political uncertainties and the DXY index's decline. So, what are the reasons to be bullish or bearish, both short and long term? In the short term, US dollar to Canadian dollar is clearly bearish. The ongoing US dollar weakness, fueled by tariff threats and Federal Reserve speculation, combined with Canadian dollar strength, points to further downside. Immediate support levels to watch are around 1.3600, which if broken, could lead to a test of 1.3550. On the flip side, immediate resistance levels are at 1.3650, followed by the previously mentioned 1.3670, and then the psychological 1.3700 mark. A break above 1.3700 would be a short-term bullish signal, but such a move faces strong headwinds currently. Long-term, however, there's a nuanced picture. The news highlights a potential long-term bullish scenario for US dollar to Canadian dollar. This is based on the anticipated rate divergence, where the Federal Reserve might need to remain hawkish longer due to higher inflation compared to Canada's more dovish Bank of Canada. If this rate divergence plays out as expected post-July 30th central bank meetings, US dollar-denominated assets could offer higher yields, drawing demand back to the USD. This would likely lead to a sustained bullish phase for US dollar to Canadian dollar, potentially reversing the current downtrend. Key long-term resistance levels to monitor would then be the 1.3800 and 1.3900 marks, which were previous swing highs. A strong break above 1.3700 and sustained buying volume would be the first major sign of such a long-term reversal. To recap, the current price is near 1.36044, close to multi-week lows. Immediate strong support is at 1.3600, with a possible dip to 1.3550 if selling pressure continues. Resistance levels are at 1.3650, 1.3670, and 1.3700. The likelihood of short-term bearishness continuing until July 30th is high, possibly 70 to 80%, reinforced by continued DXY weakness and broader trade concerns. For a long-term bullish reversal, look for a clear break and hold above 1.3700, especially after the central bank announcements. The probability of this long-term bullish turn is moderate, perhaps 50 to 60%, contingent entirely on the post-July 30th rhetoric and economic data. Watch closely for the central bank interest rate decisions on July 30th, as these will be the primary catalysts for any significant short to medium-term shifts in this currency pair. Also, keep an eye on any developments regarding U.S. tariff threats and the Federal Reserve Chair speculation, as these will continue to impact overall USD strength. Thank you for watching Explain the Charts, and remember to like and subscribe for more in-depth analyses.